Has the party ended? Has the music stopped? Do we need to grab a chair? Maybe. Let's dive in. I'm going to show you what I'm seeing from my side. You might need your cup of coffee for this one. So stick with me. My name is Brian Cannon, and welcome to Markets in 5. So the FOC met this week, the Fed basically, and decided that the rate at which they need to start raising rates is a little bit faster than in previous cycles. They're finally realizing that inflation is a problem. So for you and I that buy milk and bread, we've known this for a while, so they're just catching up. So they are scheduled to start raising rates in March. They're definitely stopping the purchase of their liquidity. In other words, buying bonds and mortgage-backed securities. So that all will have an impact on the bond market. That will all have impact on yields, the yield curve, and ultimately the stock market. So it's important to make sure that you're watching your levels and you've got a risk management process in place in order to protect on the downside and not, crossing your fingers and hoping it doesn't go down, but more proactively having a process to handle it for when it does go down. So when we dive into this chart here, you can see that, of course, we've been watching this upper channel trend for a while and then drop down and found this lower channel trend. I discussed the importance of making sure we hold that channel trend, and the more times it gets touched, the more importance that line has. And so when it broke it hard, it broke it fast, it came down. In the last Markets in 5, I'd identified several levels of support that needed to hold up or we'd like to see held up. It was either going to signal a good time to buy, or is going to sell, be a good time to start raising cash. So we've used those various levels of broken support to start raising cash. The market is right now, it's going to be very important to hold that final line. See that line, that red line right there? But essentially, that marks the previous low. And so if that gets taken out, that's a very big problem for the market. And that's something that's really the kind of the final line for us. In other words, when that breaks, we'll be going into some serious protection mode, more so than we already are. But so those are the various levels we're watching. And this next chart we had discussed in the past, but essentially when the S&P 500 and the VIX are both correlated, meaning the S&P is going up and the VIX, which is the volatility index indicator, so basically the fear index. When fear is going up and the market's going up, and those are highly correlated, generally speaking, that precedes either a period of consolidation where the market kind of just goes sideways with some volatility, or it can signal a draft down. And that's happened several times. So if you look at the chart over the last year, when you get the circle, the high correlation, it a lot of times will precede a major drawdown. And so this time is no different. So what's different is we've got this long-term support. Again, kind of the more times it touches, the more important it is. That's been taken out. So we're, again, on high alert and watching these levels very, very closely. All right, so this last chart I wanted to talk to you about is, and again, this is not a new chart. We've gone through this in the past as well, but essentially market breadth. And that's a measure of the participation of the companies inside of the S&P that are participating, right? So if the market's going up and there's a lot of participation by a lot of companies, then you're going to see a high market breadth. And if that market breadth starts to drop, in other words, less and less companies are trending upwards. In other words, they're falling below their 50-day moving average or their 200-day moving average, then that's important to note. And so we've got this long-term trend line, and just yesterday we broke it. So again, we're on very, very high alert right now. Again, we started raising cash before this, but if this thing can't recover and kind of bounce back, then that's a really bad sign. So again, you can see that the companies that are participating has dropped down to now 30%. So below 50 is troublesome. 30, if you look at that blue line I drew right there, that shows you historically it's an area that a lot of companies seem to find some support on. And so again, if we can't hold this current area we're in and start to build off of it, it's another major warning sign. So, and then also you've got the number of companies above their 200-day moving average. has fallen below 50 as well. And that, if you look historically, is also not a good sign. So the fact that we've broken our trend line, the breadth has fallen well below 50 on the 50-day moving average and just below 50 on the 200-day moving average. Not good, not good. So we're watching all of this very, very closely. So has the music stopped? Has the party ended? I'm not sure about that quite yet. We're watching it, but I would say it's definitely an opportunity that you want to at least start eyeballing your chair you're going to grab. So if I can be of an assistance, or if you need any help, by all means, give me a shout, and I'll see you on the next Markets in 5.